Well, this has definitely been a very interesting week with tariff concerns and market volatility. With the S&P 500 correcting 10%, that puts us in correction territory. Anything 20% and more would put us in a bear market territory, but it hit pretty much 10% and ripped off of those levels. This was the fifth fastest decline in 75 years of the stock market history. Now, if you're new to the channel, welcome in. My name is Colton. We work on fundamental analysis on this channel with a macro approach here. And it's really getting harder and harder to figure out, should you be bearish? Should you be bullish? What should we be thinking right now? As of right now, for the bull case, this is just a normal correction and a great buying opportunity. For the bear case, the speed at which this sell-off has begun and the fact that there's a tremendous amount of fear in this market with tariff concerns, global tension, and maybe earnings need to adjust for all this taking place as the consumer sentiment hits rock bottom. There's definitely enough to chew on for both bulls and bears, and I try to stay in the middle. Now, Tom Lee thinks that this is a great buying opportunity and should rip back up, while somebody like Jeffrey Gundlach dropped some pretty interesting data here. I'm sure most of you are familiar with the inverted yield curve, 2s to 10s to be specific, but the one thing I really like that Jeffrey Gundlach has done is put a moving average on this. This smooths out the duration of which the yield curve inversion took place, how deep the yield curve inversion was, and when could we start expecting possible turmoil. Well, we're already getting some turmoil now, and the one thing that's been holding the market up has been the labor market, specifically government jobs and service-based jobs is what we talked a lot about on this channel. But staying focused on this yield curve, as you can see here, this is our version, and this is Jeffrey Gundlach's version, smoothing out with a moving average here. We are possibly months away from an actual confirmed recession if you go off of this chart. Now, of course, we can poke holes in this, but I would say that taking your emotions out of it, looking at valuations, looking at the tariff war taking place, looking at global tension, looking at consumer sentiment, we're starting to see here that there are multiple reasons why we could be in for a rough ride as we get into the summer and to the end of this year. It's definitely been a hard market to maneuver around, high volatility, trying to figure out who's really going to get impacted by tariffs, who's going to get really impacted by global tension. It is getting more and more difficult to figure these things out, and we're actually starting to see emerging markets outperform United States, which is pretty interesting in itself. But the thing I want to point out here is our brokerage accounts up about 2.7%. About 50% is in cash and cash-like instruments. I thought this was going to be a very volatile year, and I still don't think that we're out of the woods quite yet. Now, I remember buying a house in 2009. Yes, I'm a little bit older than most of you. And when I bought that house in 2009, I didn't think anything of a recession. I had a job that paid pretty consistently. It was a very defensive job. Yes, I understood that there were some layoffs going on, and I understood housing prices were coming down 20 and 30,000. The house I personally bought was on the market for about 230. I bought it for 165 or 170, and I didn't think anything of a recession at that point in time. Now, shortly after, I found out that we were in a recession basically from 2007 to 2009, with the bottom coming in 2009. And I'm feeling a very, very similar situation here. I think we are pretty darn close to where it was for me back in 2007. I have friends that are concerned about their job and or have lost their job, and I'm starting to see real estate prices actually come down in a similar manner that 2008 to 2009 was starting to happen. Now, of course, this is just me feeling things out, but then I start stacking up this data here, and I'm saying to myself, we may be closer to a problem than we are to a new bull market. When I think about a 10% correction in the market and a recent bounce off of those levels, almost 90% of all trading is done through computers and algorithms. When the S&P 500 dips almost 10% perfectly and gets a big buying opportunity off those levels, well, as I just stated, history's shown that roughly 10% is a correction. So a lot of the algorithmic trading started buying, in my opinion, from those levels. We also found out there wasn't going to be a government shutdown, which gave a little bit more optimism. But the fact of the matter is we're still dealing with a lot of political tension. We're still dealing with a tariff war right now. And so I'm not so sure that the selling is done, even though I do think we could see a pretty substantial bounce from here, but a lagging indicator of the labor market is going to be the confirmation, in my opinion, that we finally hit recession. But once that labor market spikes, I think it's going to be a little bit late here. So we already went over the 2s to 10s, consumer sentiment, political tension, valuation. Now the last domino to fall, in my opinion, is going to be the labor markets. And when we get those big spikes in the labor market, that confirms the recession. It's not necessarily where we're coming from. As we can see here, we had extremely low employment in the 50s, and we had a spike up and got the confirmation. We had extreme low employment before COVID, got the spike up. Obviously, we know what happened there. But we can go back in time and see that low unemployment is not really necessarily a trigger for a recession or not. It's the move of which it makes. And I think that I think going from 4.1 to about 4.5 would be enough to trigger this recession when we topple it with everything else that we're kind of seeing here. And so when we see the nice upward trajectory of both 90-day and 200-day moving average, we can see that when we smooth everything out, that it's a nice upward trajectory here. But what are we starting to notice after this very, very fast decline here? We're starting to see that the moving averages are flattening out. So while I do think we can get a nice rally and possibly rally back up to the 90-day moving average, possibly getting back up to 5950 in the S&P 500, I do think it's going to get harder and harder to make newer highs. If we just take it from this low right here, we have 1, 2, 3, 4, 5, 6, 7 lower lows in this market in a very short period of time. So the trend, even though it bounced, hasn't really changed as of yet. And so the technicals are starting to tell me we need to be a little bit concerned here. We topple that with valuations once again. And I definitely think we're not getting a deal, even buying after a 10% dip. Now, within there, I do think there's a lot of names becoming interesting, and maybe we'll get into that in the next video, as I'm going to reposition it very uniquely here. I think mid-cap quality is getting very interesting. I think some individual companies in emerging markets are getting interesting. And I also think it could make sense to look at the longer end of the yield curve. Now, as I did show you Jeffrey Gundlach's chart here earlier, he believes that we could see the longer end of the yield curve actually spike up, which makes you a little bit nervous. There's a few things I'm starting to find interesting here. Obviously, US technology is definitely pretty weak. We've seen companies like Apple and Google sell off and not really reclaim those highs again. And then I take a look at something like KWEB, the China Internet ETF, that's up 43%, nearly 44% in 6 months. While over the last 6 months, the S&P 500 has been pretty much dead money, flat on the last 6 months. This is telling me that valuation is actually starting to matter. Chinese stocks were super cheap, super depressed. The worst was being priced in, and you could have got a lot of these companies trading for single-digit PE ratios, while the US stock market was trading over 25 times earnings. So this is telling me that the market's starting to care about valuation as political tension picks up and uncertainty picks up. Now, the hardest part is figuring out who's really going to be impacted. Are tariffs even going to stay, or is it just a threat? Are we in a correction, or is this a beginning of a bear market? Now, for me, I try to really keep an even keel here, and I think there's two ways to look at this. I think if Doge checks are pushed back out again, we could be looking at asset bubbles, we could be looking at a beginning of a new bull market. But I think if these cuts are real, if government cuts are going to be real, if government spending is going to slow down, if the tariffs are going to stay on, I tend to think that we are possibly looking at a new bear market here, especially if the unemployment picture changes, which I do think could happen. That was the week in a rear view. That's my 2 cents. And as always, guys, really appreciate your time. Thanks so much for spending it with me, and we will see you all in the next.